Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Tuesday, March 25th, 2025. So we passed on doing the podcast yesterday on Monday because we did have a webinar featuring an analyst from DFA, Dimensional Fund Advisors, and Charles discussing certain topics about the economy, Bitcoin. So if you were not able to see that in real time yesterday, it was at noon, we do have that recorded. So if you are a Zhang Financial client and you want to see that, just reach out to your client service manager. They can send you the replay link and the password. So economic activity last week. Again, we're looking for signs of a decelerating economy. There's much more concern now about a recession, particularly over the last month. We've had a few data points, as we've reported here, that were less than stellar over the last month, but nothing that looks like certainly a recession. A bit of a slowdown from what we saw late in the fourth quarter of last year. So we'll go through these economic data points. The takeaway early on just the preview here is that in total, they're pretty good. So again, we just don't see that smoking gun suggesting that we have a hugely decelerating U.S. economy. So data points last week, retail sales ex-auto. That was for the month of February. And so the consensus for retail sales month over month was 0.6. It came in at 0.2. So that's negative. But if you strip out autos, the consensus was a positive 0.4. It actually came in higher at 0.5. So the takeaway there, retail sales, a little underwhelming. However, it looks like it was relegated to the auto industry. Poor auto sales in February. That's the assumption here. The next day, Tuesday, we had building permits and housing starts. Now, we don't focus a lot of time, for better or for worse, on these metrics. They don't generally move the market. They don't really move the economy necessarily. They're a reflection of it. But building permits, housing start for February, in both cases, better than consensus expectations. So last week, the big event in our view, the Fed interest rate decision that came on Wednesday. They decided not to lower rates. We previewed that. It was built into the futures. There was no expectation that they would. But there are a couple of takeaways from that. Number one, the Federal Reserve expects for 2025 U.S. economic growth to come in at 1.7%. Now, that would be really a good outcome, we think. Last year, total for the full year, so I believe it was 2.8% for the full year. We had a couple of quarters that were really good, but 2.8. So if we did decelerate and it goes down to 1.7, all things considered, that would be pretty good. It would take pressure off inflation. That would be great. 1.7% growth is still pretty good. So last year, of course, being an election year and some of that spending, we suspect it happens. Doesn't matter if it's who's in office. But that last year, that election year, government spending tends to get a little out of control. It did last year as well, artificially inflated GDP growth. So again, growth was great last year, 2.8, and this year 1.7 would be a very good outcome, we think. So also last week, initial jobless claims came in as expected, a little better than expected. 224,000 was the expectation for new claims, came in at 223. Existing home sales, again, this really doesn't move the needle, doesn't matter that much, but existing home sales, a very impressive beat, was expected to come in at 3.95 million, came in at 4.26 million. So here, now we're going to take a look at GDP growth expected here in the first quarter. We always go to the Atlanta Federal Reserve, take a look at their GDP now, and we were stunned. We reported this here on the podcast 3 weeks ago, when they dramatically took down expectations for first quarter growth. And they went from a positive, at one point they were at 4%, expected 4% growth in the first quarter, and they took it down ultimately to a negative 2.8%. So that's just an amazing switch within really, I think it was a 4-week time frame. And maybe it happens, but the economic data that we're seeing does not corroborate it. So last week, the Atlanta Fed did change their expectation just slightly. So the week before, they had moved it from that negative 2.8 to negative 2.1 and further reduced the negative element last week to a negative 1.8% GDP growth in the first quarter, way below what the blue chip economist consensus is at. I don't know anyone that's that low either. So something's going on there. We're not sure what. We'll try to figure it out and communicate it. Inflation expectations hardly moved last week, up 3 basis points. It is now at 2.33% expected inflation average over the next 10 years. Now, there's another Fed meeting coming up in May, and the expectation is no cut again. The expectation is 88% probability of no cut. That actually is higher than last week. Last week it was 78% probability. Now almost no chance expectation of a May cut, despite the fact the Atlanta Fed thinks we're going to shrink GDP by 1.8%. So we'll see. Fed funds future, though, also in terms of expectations through the end of the year. The other big takeaway from the Federal Reserve, Jerome Powell, his meeting, his press conference on Wednesday, is that we can expect 2 more rate cuts throughout the rest of 2025, and that's what's priced into the futures market. So 56% probability that we'll get 2 interest rate cuts this year, 50 basis point total, 23% probability that we'll get 3. So the markets last week, we had 4 losing weeks in a row on the S&P 500 with a very strong Friday. We broke that stretch, so the S&P 500 up last week, great. It was up about 0.5%, 53 basis points. Underneath that, though, value, and this isn't large, this is huge, but value outperformed growth, and value was up 1.1%, growth 0.7, rounding up and down. However, on a year-to-date basis, it's becoming pretty stark. Now, last year, growth way outperformed value, but so far on a year-to-date basis through last Friday, growth in the U.S. down 0.5%, value up 3.5%. So that's pretty significant. We'll see if that keeps up. In terms of trends, international has outperformed the U.S. this year. Now, it's been 15 years since full year. International has been ahead of domestic. But again, last week, despite the fact S&P was up, the rest of the world was actually up more than the U.S. So developed market ex-U.S. up 0.9%, emerging markets up 1.1%. So on a year-to-date basis, the S&P 500 is down 3.3%. The developed market ex-U.S. is up 8.9%, and emerging markets up 9.2% or 5.2%, led by China up nearly 18% year-to-date. Fixed income also up last week. The 2-year and the 10-year yield in both cases dropped 6 basis points. So we had a strong bond rally last week. Bloomberg U.S. Aggregate Bond Index up 0.5%. And on a year-to-date basis, this is a very strong result over a short time frame. The year-to-date, the Bloomberg U.S. Aggregate Bond Index up 2.6%. Let's switch gears. Coming up this week in terms of economic activity. Today, Tuesday, there were new home sales. Haven't seen it yet, but expectation is they will come in at 680,000 for the month of February, up from what we saw in January at 657. On Wednesday, tomorrow, durable good orders. Now, this is another one of those dichotomies like we talked about in retail sales from last week, in that durable goods orders month over month for the month of February expected to be down 1%. Month of January was up 3.1%, but strip away transportation, durable goods ex-transportation expected to be up 0.2% month over month. In the month of January, it was flat. So take away the lumpy big ticket items, ex-transportation, and durable goods actually expected to be up in the month of February. Thursday, as we always do, we get the initial jobless claims. Again, last week it was 223,000 new claims, expected 225 for this week. Pending home sales is kind of a throwaway. But again, just another data point which kind of suggests if we do hit this number, things aren't falling apart. Pending home sales during the month of January was down negative 4.6%. For the month of February, it's expected to be up 1.5%. Friday, as often is the case, is the big day in terms of economic data this week. We get the PCE, the core PCE, and the PCE headline number. In both cases, they are expected to be up month over month, 0.3%, exactly as they were in the month of January. So no big surprises expected for the PCE or core PCE. Now, personal spending, however, was very strong, or personal income was very strong in the month of January, up almost 1%. It was up 0.9%. That's expected to drop, but still be positive, a positive 0.4%. Again, there's two edges of the sword here. Personal income, if it's accelerating too high, then you're going to get too fast. You're going to get personal spending pushing inflation. So a positive 0.4% month over month, I think, is a really good metric. Lastly, personal spending. That was down 0.2% during the month of January. That's expected to be a positive 0.5%. So again, we look at all these data points from last week, the economic activity reported, and what the expectations are during this week. We just have to conclude that the Atlanta Federal Reserve calling for now a 1.8% drop or negative GDP growth in the first quarter seems to be an outlier. It seems like economic activity indeed probably is slowing from very high levels late last year, but we do believe it is still positive. So that's it for our recap for this week. We thank you very much for attending. We'll look forward to seeing you next week. Thank you.